What's the real difference between a bull and a bear market? And how do these cycles actually work? If you've ever invested in the stock market or followed financial news, you've probably heard these terms thrown around, but maybe you're not entirely sure what they mean. Let's break it down in simple terms. A bull market is when stocks are rising and investors are feeling optimistic about the future, like a big wave carrying everything upward. On the other hand, a bear market is when stocks are falling and investors are more cautious, like a big storm cloud hanging over the market. But here's the surprising part. These cycles aren't just random events. They're actually driven by a complex interplay of economic factors like interest rates, inflation, and consumer spending. The first key factor is economic growth. When the economy is growing, businesses tend to do well and their stocks rise, creating a bull market. And the second factor is investor sentiment. When investors are feeling confident, they're more likely to buy stocks, driving prices up even further. The third factor, and this is the one that surprises everyone, is the role of market psychology. How investors think and feel about the market can actually create a self-fulfilling prophecy where a rising market reinforces itself and a falling market can spiral downward. Understanding how these factors work together is crucial to grasping the real difference between bull and bear markets. What's the real difference between a bull market and a bear market? And how do they actually work? Imagine the stock market as an ocean, with the tide representing the overall direction of prices. A bull market is like a rising tide, where investor confidence and demand for stocks drive prices up, lifting all boats, so to speak. Just as the rising water level makes it easier to navigate and find new opportunities, a bull market makes it easier for companies to grow and for investors to make money. On the other hand, a bear market is characterized by falling prices and a loss of confidence, like a receding tide where the water level drops, exposing rocks and making navigation more difficult. And here's the surprising part. These cycles are not just about investor mood, but about the underlying economy. The tide of a bull or bear market is often driven by real economic factors, such as interest rates, inflation, and employment rates, which can either support or undermine the market's direction. Understanding this relationship between the market and the economy is key to grasping the true nature of bull and bear markets. By recognizing the underlying mechanisms that drive these cycles, you'll be better equipped to navigate the markets, regardless of whether the tide is rising or falling. To learn more about how these mechanisms work and how to make sense of market cycles, be sure to subscribe to our channel for more in-depth explanations, vocabulary, confidence, demand, navigation, underlying mechanisms. What drives the shift between a bull and a bear market? And how do economic indicators and market psychology play into this cycle? To understand this, let's break it down into two key components. First, consider the economic indicators such as GDP growth, inflation rates, and interest rates. These are like the engine of a car, determining how fast or slow the economy moves. When GDP growth is high and inflation is under control, it's like the engine is running smoothly, supporting a bull market. On the other hand, high inflation or rising interest rates can be like throwing sand into the engine, slowing it down and potentially leading to a bear market. And here's the part most people don't know. These indicators can sometimes send mixed signals, making it hard to predict which way the market will turn. The second component is market psychology and sentiment, which can be thought of as the driver of the car. Even if the engine is running well, if the driver is nervous or overly optimistic, they can still crash the car. In the same way, market sentiment can sometimes override the fundamentals, leading to market fluctuations that don't seem to make sense based on the economic indicators alone. Understanding how these two components interact is crucial to grasping the mechanisms behind bull and bear markets. By recognizing the role of both economic indicators and market psychology, you can better navigate the market cycles. To dive deeper into how these mechanisms play out in real-world scenarios, let's explore some examples in the next section. Vocabulary, inflation, sentiment, indicators, fundamentals. After understanding the mechanisms that drive our market cycle, let's dive into how we actually recognize a bull versus a bear market. If you're like most investors, you might wonder, how do I know if I should feel optimistic or worried about my investments? The first thing to look at is trends in major indexes. Think of these indexes as the heartbeat of the stock market. For example, the S&P 500 is a big index that represents 500 large companies traded on U.S. exchanges. If you see this index gradually climbing higher over time, like a runner steadily increasing their pace, it's probably a sign we're in a bull market. The opposite happens during a bear market. The S&P 500 will show a steady decline. And here's the surprising part. Investors also closely watch the overall health of the economy as an additional indicator. It's like looking at your body to see if you're feeling good or not so great. For instance, employment rates and consumer spending can tell us a lot about market strength. If more people are getting hired, spending money on new gadgets and services, it usually means the economy is doing well, which often translates to a bull market. But if we start seeing job losses and reduced spending, that could signal a bear market. So, to sum up, you can spot a bull or bear market by looking at these two main indicators: the direction of major indexes like the S&P 500 and the overall health of the economy through factors like employment rates and consumer spending. These give us a clear picture of where the market is heading. What happens when you don't understand the difference between a bull and a bear market? And how can knowing this impact your investment strategy? Let's break it down. When you're investing in a bull market, everything seems to be going up, and it's easy to get caught up in the excitement. But here's the surprising part. A bull market can also make investors complacent, leading them to take on more risk than they should. On the other hand, a bear market can be daunting, causing investors to sell their assets at low prices, only to miss out on the potential gains when the market recovers. The key to navigating these market cycles is to have a clear understanding of your own risk tolerance and investment goals. By diversifying your portfolio and taking a long-term perspective, you can mitigate the impact of market downturns and capitalize on the growth opportunities in upswings. Think of it like a ship navigating through waves. You can't control the waves, but you can adjust your sails to make the most of the wind. And here's the part most people don't know. Even in a bear market, some sectors or assets can still perform well, providing opportunities for investors who are prepared. By understanding the difference between bull and bear markets and managing your risk accordingly, you can make more informed decisions about your investments. To learn more about how to navigate the complexities of the market, be sure to subscribe to our channel for more explainers on investing and the economy vocabulary, portfolio, diversification, perspective, tolerance, mitigation. So, what's the real difference between a bull and a bear market? Is it just about prices going up or down? Well, as we've seen, it's much more than that. It's about the underlying economic trends and investor psychology that drive these cycles. In a bull market, you have low unemployment, rising GDP, and investors who are optimistic about the future, and this collective enthusiasm drives prices higher. On the other hand, in a bear market, you have slowing economic growth, rising unemployment, and investors who are fearful about the future, and this pessimism drives prices lower. The third key aspect is the impact of market cycles on investors. And here's the surprising part. It's not just about making money or losing it, but about understanding how these cycles can affect your overall investment strategy and financial goals. Now that you understand how these cycles work, you can make more informed decisions and navigate the markets with confidence. You'll be able to recognize the signs of a bull or bear market and adjust your investments accordingly. And that's the key takeaway. It's not about predicting what the market will do next, but about understanding how it works and making informed decisions based on that knowledge. If you'll never look at the markets the same way again, and you want to stay ahead of the curve, be sure to subscribe for more in-depth explanations of how the markets actually work. Vocabulary, confidence, enthusiasm, pessimism, navigate, strategy.